Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Scholar Rock Holding Corporation Annual Report. Scholar Rock Holding Corporation is a biopharmaceutical company that specializes in developing medicines for serious diseases where protein growth factors play a crucial role. The company's proprietary platform enables the development of monoclonal antibodies that target specific precursor molecules. The company has several product candidates in its pipeline, including apitegromab, which is currently in Phase 3 clinical trials for the treatment of spinal muscular atrophy. Another candidate, SRK-181, has completed Phase 1 clinical trials and is being developed to treat cancers resistant to checkpoint inhibitor therapies. In addition to these two products, Scholar Rock Holding Corporation is also working on a pipeline of product candidates that aim to deliver novel therapies for various serious diseases. These include neuromuscular disorders, cardiometabolic disorders, cancer, fibrosis, and iron-restricted anemia. The company's focus is on developing medicines that can be delivered locally and selectively, reducing the risk of side effects associated with traditional treatments. With its proprietary platform and pipeline of product candidates, Scholar Rock Holding Corporation is poised to make a significant impact in the field of biopharmaceuticals. The stock price of Scholar Rock Holding Corp. SRRK has experienced a significant surge over the past year, rising by 31.28%. This upward trend can be attributed to several key factors. Firstly, the company's lead therapeutic candidate, apitegromab, for spinal muscular atrophy, SMA, has made substantial progress in regulatory approvals and clinical trials. In November 2025, Scholar Rock completed a constructive Type A meeting with the FDA, paving the way for the resubmission of the apitegromab BLA. The company's manufacturing partner, Catalent, also reported progress on remediation efforts at its fill-finish facility, expecting readiness for reinspection by the end of 2025. This positive news was followed by a constructive meeting between the FDA and Catalent in March 2026, where no additional corrective actions were requested. In addition to regulatory progress, Scholar Rock has also made significant advancements in its pipeline programs. The company highlighted its strategic priorities for the year, reinforcing the anticipated apitegromab BLA resubmission and U.S. launch. Furthermore, it detailed the initiation of a Phase 2 study for apitegromab in facioscapulohumeral muscular dystrophy, FSHD, and progress with SRK-439. The company's financial position has also been strengthened, securing a new debt facility of up to $550 million from Blue Owl Capital. This non-dilutive capital is expected to support the commercialization of apitegromab and the strategic advancement of its pipeline. Scholar Rock ended 2025 with $367.6 million in cash, cash equivalents, and marketable securities, projecting a cash runway into 2027. The positive analyst coverage and price target increases have also contributed significantly to the stock price increase. Several financial analysts issued positive ratings and increased price targets for SRRK, including Barclays, UBS, Citigroup, H.C. Wainwright & Co., and Truist Securities. These revised price targets signal increasing market confidence in Scholar Rock's future performance. In conclusion, the combination of regulatory progress, pipeline advancements, strengthened financial position, and positive analyst coverage has driven the significant increase in Scholar Rock Holding Corp.'s stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company are multifaceted. The commercialization of apitegromab is a significant factor, as it has the potential to generate substantial revenue if approved by regulatory bodies. Additionally, the development and approval of additional indications beyond SMA and FSHD can further boost revenue. Partnerships with other companies for early-stage pipeline programs can also contribute to growth. Furthermore, continued development activities for apitegromab in other neuromuscular disorders can provide a steady stream of revenue. The achievement of milestones or the occurrence of developments that trigger payments under collaboration agreements can also have a positive impact on revenue. Commercial sales of apitegromab, if approved, will be a major driver of growth. However, there are also potential drivers of revenue decline. Failure to raise sufficient capital through various means can hinder growth and lead to a decline in revenue. Changes in tax law that adversely affect the company's business and financial condition can also have a negative impact on revenue. The net income and profit margins of the company have undergone significant changes over time. Initially, the company did not have any applicable data due to its lack of commercialized products, page 58. However, as it began to face disruptions in workforce and communication, page 73, its net income decreased. Further analysis revealed that unsatisfactory pricing levels in EU markets, reimbursement limitations or denials, and potential for cross-border reference pricing negatively impacted the company's net income, page 83. The situation worsened with a net loss of $246.3 million in 2024 and $377.9 million in 2025. Profit margins also experienced significant changes. Initially, they were not applicable due to the lack of revenue generation, page 58. However, potential losses from cybertax or employee misconduct, increased costs associated with regulatory compliance, and substantial tariffs on pharmaceuticals negatively impacted profit margins, pages 73 and 74. The company's low prices in EU markets compared to US markets, stringent reimbursement limitations or denials, and the potential for a cascading effect across multiple markets further negatively affected its profit margins. The lack of revenue generation and continued research and development expenses contributed to increased losses from $246.3 million in 2024 to $377.9 million in 2025. The company's debt level and interest expenses have undergone significant changes over the past period. Initially, the total outstanding balance under the term loans increased to $100 million, a substantial rise from its previous value of $50 million. This increase was followed by the repayment of all outstanding obligations, totaling $103.7 million under the existing loan agreement with Oxford in February 2026. However, this repayment was soon offset by the company's entry into a new loan agreement with Blue Owl for up to $350 million in the same month. This development suggests that while the debt level may have been temporarily reduced, it has since increased significantly. Furthermore, the presence of a debt facility has led to a substantial change in interest expenses, as indicated by the decrease in net cash provided by financing activities from $353 million to $228.4 million. Overall, these changes suggest that the company's debt level and interest expenses have undergone significant fluctuations over the past period, with no clear indication of stability or consistency. The management is signaling a cautious outlook for the company, as evident from the significant net losses reported. Despite this, they have demonstrated financial discipline by repaying outstanding debt to Oxford using proceeds from a new loan agreement with Blue Owl. This strategic move suggests that the company is committed to managing its finances effectively and reducing its liabilities. The management's focus on consolidating financial information on a single reportable segment indicates a streamlined approach to operations. However, the net losses reported raise concerns about the company's ability to generate profits in the current market conditions. The repayment of debt and the use of new loan proceeds may provide some relief, but it remains to be seen how these actions will impact the company's long-term financial performance. Overall, the management is taking steps to address the company's financial challenges, but the outlook remains uncertain. Further analysis is needed to understand the full implications of these developments on the company's strategy and future prospects. The company's stance on dividend payments is clear. According to the provided information, there are no plans to pay dividends on its common stock. In fact, it has been explicitly stated that the company has never declared or paid any dividends. This suggests a focus on retaining earnings and reinvesting them in the business, rather than distributing them to shareholders through dividends. That concludes the financial summary for Scholar Rock Holding Corporation. Feel free to comment below, and I will be happy to answer them when possible.